Hello and welcome back. Now we're still looking at share capital here. We're looking at companies' finance. Before we start on this worked example, I want to introduce you to a few terms to do with share capital. So I'm just going to open a blank piece of paper here. Now, let's assume that this box represents my £1 ordinary share. So when we get to the top of this box, we've paid our full pound over to the company. Now, when my company is first set up, it doesn't have a lot of expenses. It knows it's going to need more money to expand in the future, but it doesn't need all of the money straight away. So the shareholders initially pay 25 pence against that £1 that they owe the company. Now, this is a partly paid share. My share is partly paid up by 25p. That means that I have uncalled for capital of 75 pence. Now, after a year or so, my company's doing quite well. It needs more money to expand, but it knows all its shareholders still owe that uncalled for capital. So it issues a call on capital, and it makes a call to all its shareholders to call on capital for each shareholder to pay over another 30 pence. So each shareholder will have to pay 30 pence for every share that they own. This is now called for share capital, and once it's paid over to the company, it becomes paid up share capital. However, there is still, on this particular company, 45 pence, being a pound less the 30 and the 25 that's already been called for, of uncalled for capital. Now, if the company never gets around to calling for that capital and perhaps goes into liquidation or something like that, that 45 pence is still owed to the company and the shareholders will have to pay it over. Once we've paid the full amount, so once I've paid the whole amount, my share will become fully paid up. Okay. Now note this £1. This £1 is the nominal value of my share. Now the nominal value of my share is fixed in the articles. It's part of sort of the name of my share, if you like, the description of my share. It's not the same as the market value of the share. The market value of the share is what that share could be sold for in the open market. If it's a listed company, what it's quoted for on the stock exchange. That value, the market value, will rise and fall according to the company's fortunes. So armed with that information, I think we can probably have a look at the worked example, portions. Portions are the £101 shares and it's issued at 80. It's received 25 pence per share on application and has called on the holders for a further 15 pence per share. Well, the company's share capital here is £101, 100 times £1. Its issued share capital, however, is only £80 because the company has issued 80 shares and they are each ordinary £1 shares. However, even of that £80, the company has only called for some of its capital to be paid for it. And it's actually asked for, originally it had 25 pence per share, and then it asked for another 15 pence per share, which takes us up to 40 pence per share. And we have 80 shares in issue, which is going to give us called up share capital of £3,200. Sorry, that would be a little bit extreme, wouldn't it? We're dealing in pence here, not pounds. So actually, our called up share capital is £32, isn't it? If we just go over the page here, what is the company's paid up share capital? Well, it hasn't actually received that second call yet, has it? So its paid up share capital is 25 pence per share times 80 pence, times 80 shares even. And that means that we've got paid up share capital of £20. And if we wanted to, we could work out our uncalled for share capital, the bit that the company hasn't asked for yet. We know called up is 40 pence, so the uncalled for bit would have to be 60 pence, wouldn't it? and that would mean that we had another £48 of uncalled for capital. Now, because a company has the benefits of limited liability, it's subject to fairly rigorous capital maintenance rules. Now, by capital maintenance, this is where the law tries to stop the company's shareholders from drawing funds out of the company so that there's no money available to pay the company's creditors. And it does this in a number of ways. The first one, it restricts dividends. Dividends can only be paid out of a company's distributable reserves. It has a rule that you can't issue shares at a discount to their nominal value. There's also a rule that you can't reduce your share capital unless you follow strict rules that are set out in the legislation. Now, it is a slightly misleading, really, because these rules mean that money that's paid into the company can't be stripped out and paid back to the shareholders. However, for most companies, their share capital is their working capital, and they use that for the day-to-day running of the business. So although the money can't be repaid to the shareholders, it could quite easily have been spent by the company, so that in practice it isn't there to pay the shareholders. So, first thing we need to look at is a reduction of share capital. If a company wants to reduce its share capital, how does it do it? Well, first of all, why? Well, a company might do it if its share capital is higher than its needs. It's got money in the company that it can't distribute, but it doesn't actually need to have it there. Another reason it might do it is because its net assets have fallen below the amount of capital. Now, if that happens, the company needs to sort of reset the clock. It needs to get the net assets and the share capital back into balance, because that discrepancy there is going to stop the company from paying a dividend. So how do they do it? Well, you could reduce the liability on partly paid shares. So imagine that I have a £1 share, and my £1 share is 60p paid up. Well, if the company doesn't need the extra 40p, it's not going to call for it. So what we might do instead is we might make our share 60p fully paid. So its nominal value will be 60p, and it's now fully paid up. So I no longer owe the company that extra 40p. Similarly, we might decide if the share capital has already been paid over, but we don't need it, we might return it to our shareholders. But again, we can't just return it, we're going to have to reduce the nominal value of the shares. So this time I have a £1 share fully paid. So I change the nominal value of my share, I make my share nominal value 60p, and I repay my shareholders the 40p that I don't need anymore. Okay. So that's ways I might seek to do that. Now, you can come up with other ways, but those are the ways that the Companies Act recognises. Now, there's a strict procedure about this. How do you do it? Well, if you're a public company, you have no choice. You have to go this route here. So route is open to public companies and private companies, but there's a better route for private companies, provided they are solvent. So this route would be used by public companies and also by insolvent private companies. And it's pretty simple. We start with a special resolution of the company, so 75% of the shareholders have to agree, and then we make an application to the court and ask the court to confirm that this reduction in share capital can be made. Now, what the court are looking for here is they're trying to make sure that all the shareholders are treated fairly, but perhaps more importantly, they're trying to make sure that the creditors are treated fairly. So the court will normally order that notice has to be given to the creditors of the reduction in share capital. Now, companies don't like to do this because creditors generally panic when they get a notice like that. They think that something's wrong. And often there may not be. So what companies may do is they may try and get a bank guarantee for the amount of the company's debt. So they deposit money with a bank, and in return the bank agree that they will hold that money and use it to pay the company's debts if need be. The other thing they might try and do is pay down their debts. Make sure that the number of creditors they have when they go to the court is as small as possible. And if they can do that, they might be able to convince the court to dispense with this notice to creditors, and that avoids that sort of rather embarrassing publicity requirement. Once the court's approved the reduction in share capital, the directors have to file a copy of that special resolution and a copy of the court order with the company registrar, and then they can go ahead and make the necessary adjustments. Now, if you're a private company, the rules are slightly more relaxed because you're a private company, you're not dealing with the public's money as often. So the rules here still start with a special resolution, but this time, instead of going to court, you can produce something called a solvency statement. Now, the solvency statement is a document that's signed by all the company's directors, and this solvency statement has to be filed with Companies House within 15 days of the date of the special resolution. And what this solvency statement says is that the directors know of no reason why the company should become unable to pay its debts within the following 12 months. Now, you don't give that statement lightly, because if you do, you could be in breach of your director's duties, you could be committing fraud. So you've got to be pretty careful with that. Now, the resolution and the solvency statement are filed with the company registrar, and again, the reduction in share capital can continue. Another thing a company might consider is a purchase of its own shares. So it buys its shares back. Now, if you're a public company, when you buy shares back, they go into something called treasury, and they're kind of held there until they can be reissued to a new shareholder. But if you're a private company and you buy your own share, you can't really own shares in yourself. It's a bit circuitous, isn't it? So those shares would just be cancelled. Now, the court will allow you to buy your own shares if you've got a court order, or if you've followed the appropriate procedure, or if you're forfeiting shares. So basically, a shareholder has failed to meet a call on capital, and therefore you have seized their shares and forfeited them. Now, again, because by purchasing your own shares you are reducing your share capital, there are rules about it. So first of all, a couple of terminology: market purchase and then off-market purchase. It just means a market purchase is made on a recognised investment exchange. So if you're going to buy shares back on the stock market, then that means that you're going to have to agree with your shareholders a range of prices, because that price will fluctuate on an hourly basis or almost by the minute. If it's an off-market purchase, that means that you are negotiating with an individual shareholder. Therefore, it's possible to agree the price with your shareholders up front and before you draw up that contract. Now, in practice, it's probably more likely to be an off-market purchase, because you're quite likely to be buying the shares, perhaps of maybe an outgoing director. Rather than him having to sell his shares to someone else and bring in a new director, it might be easier for the company to buy out his shares and cancel his interest in the company. And it's sometimes a tidier way of dealing with things, and possibly more tax efficient as well. Just worth noting there, the accounting treatment where you do purchase shares out of a company's profits, because that creates a capital redemption reserve, and that is pretty much treated as companies' paid up share capital, except you can use it to allot new shares. Now, another way of reducing your share capital might be redemption of shares. Now, redeemable shares are a special type of shares. They are issued on terms that say they will be redeemed at a later date. Now, what that means is you write that into your articles. So sometimes, if you think about Dragon's Den, for instance, the dragons may say that they're prepared to invest on the basis that if certain profit thresholds are reached, they will cancel their shares. And what that quite often means is that they'll issue them on a redeemable basis. So once the company reaches a certain profit threshold, that will trigger the redemption, and the company will buy back that dragon's shares. Now, there is a rule that says you can't only have redeemable shares, because obviously once they're all redeemed, you've got no shares. So there must be at least one unredeemable shares. Now, this table summarises the key points that a company must consider before it either makes a purchase or a redemption of shares. And you'll see that once again it's divided into two columns. We've got the rules that apply to any company, and also slightly less stringent rules that apply to a private company. So First of all, you can only repurchase fully paid shares, so you might arrange for them to be fully paid up immediately before the purchase or redemption. The articles must allow you to do it, and you have to have a non-redeemable share in issue after you've made this purchase. Now, this is where the difference comes up. A PLC, a public company, must only use what we call available profits. And this is broadly distributable profits that you can use to pay a dividend. And also if you've issued a fresh share issue, just to raise the funds in order to finance this repurchase. So perhaps you're buying back the shares of one director and issuing shares to a new director who's joining the company. If you're a private company, you have to use those available profits first, but once you've done that, you can use capital to fund the purchase. However, you need to be solvent, you need to pass a special resolution, you need your shareholders' approval, there's a publicity requirement, and also timing, so you must actually make that payment within quite a short time from having your shareholders' approval. What else could you do with your share capital? Well, there's all sorts of things you could do. You could increase your share capital, you could issue more shares. And you could either subdivide or consolidate your share capital. The thing here that you might think is odd is that you only need an ordinary resolution to do this, because you're not changing the overall level of share capital, you're just rejigging it. So instead of having 10 £1 shares, you might have 100 10p shares. So long as you don't change the totals, that's fine. And you can do that in reverse as well if you wanted to. You could go from having 10 £1 shares to having 5 £2 shares. Another thing you might want to do is to change the currency of your company, perhaps with all the upheaval with the euro, or perhaps if Scotland ends up with a Scottish pound, we may find that we want to redenominate our shares, and that's fine, you can do that, but the same rules apply really. There is a small rounding allowance there, so you may never find that you can get quite the same right number of euros, whole euros, to give you an even share capital, so you can tweak it a little. And then just at the end there, just a couple of points. This first one, PLC in crisis. This applies where the net assets of a public company have fallen to less than half of its called up share capital. So things are out of balance, and the law says that the directors must call a general meeting to decide what to do. Also, another point there, public company. If you're a public company and for some reason the nominal value of your shares falls below 50,000, then you must deregister, because a public company, remember, must have a minimum of £50,000 of share capital. Now, there is also a rule about something called financial assistance. Now, this relates to where a company provides money, either directly or indirectly, to someone to allow them to purchase shares. Now, that is a criminal offence, and you can be either fined or imprisoned if it's a serious case, if you breach the rules. However, in the latest Companies Act, these rules were relaxed slightly, so let's have a look at that. Now, although the rules can be a bit complicated, for your exam, you really do just need an overview. And the key point to learn there is that private companies can now give financial assistance. Okay, and we'll have a look. There's one caveat to that, which is on the next page, because that applies to all companies. Oh, sorry, no, it's here, look. So a private company can give financial assistance if that financial assistance does not reduce the company's net assets, or more likely, it's covered by distributable reserves, and it's given in good faith and in the interests of the company. A public company is not able to give financial assistance because a public company is likely to be able to offer its shares to be quoted on a stock exchange, as it's able to offer its shares to the public. And if a company is allowed to give financial assistance, it might be able to manipulate its own share price, and we don't want that to happen. However, there are some fairly detailed exceptions to this rule. You can give financial assistance if the principal purpose of the assistance is not the acquisition of the shares, but something else. And the assistance is only incidental to some larger purpose. And what we're looking at there is perhaps where a company helps its shareholders, perhaps by providing legal advice on the sale of shares, in order to facilitate, say, a company takeover or an MBO. So the purpose isn't actually to allow that person to buy or sell shares in order to manipulate the share price. The purpose is to facilitate a commercial transaction. There are also a number of specific exceptions, and they apply to both public companies and private companies. So if you're a bank, for instance, and you lend money to someone, which they then use to buy shares in your bank, although technically that's financial assistance, that would be outside of the legislation because of this exemption. Purposes of an employee share scheme. So again, if a company is funding a share scheme which will buy shares in the company to issue to employees, that's okay too. And also loans to employees, if that's to let them acquire shares in the company. It's thought to be a good thing if employees own a stake in their company, and generally legislation tries to facilitate that. So don't get too bogged down with financial assistance. I would just try and learn the broad headings there. It's a pretty complicated rule that lots and lots of people in practice don't fully understand. Okay, the next thing then, a question. Have a look at this question, pause the recording, and then restart it and compare your answer to mine. Okay, those are my answers. A public company is much more tightly regulated, remember, than a private company. So they're not able to buy shares out of capital. They can buy back redeemable shares, but they must use reserves available for the purpose. Similarly, a purchase of own shares. They could provide a loan to an employee for the purpose of acquiring shares in a company, but not to a director, although a private company could provide financial assistance. A public company and a private company can make a reduction of share capital if it's authorised by the court. However, a public company wouldn't be able to do that following the declaration of solvency route. Now, the final point on shares is this point about dividends, a pretty important one, and probably the one above all others that you definitely need to learn. So what is a dividend? Well, a dividend is the return on your investment, the return on your share capital. And it's a distribution, as it says there, of the company's assets to the company. It actually doesn't have to be a cash dividend. It could be a distribution of assets as well. Now, the general rule, distribution can only be made out of profits available for the purpose. And what we mean there is distributable reserves. So here's a definition of distributable reserves. Again, you need to learn this one. So these are accumulated realised profits less accumulated realised losses that haven't been used before. So basically, if you've accumulated your profits, you also accumulate your losses, you net the two off year on year. And as long as you've got a positive balance there, you can use that to pay a dividend. Once you've paid a dividend, you have to take that out of the cumulative total. You can't use it again. Okay, key points also, realised profits, realised losses. We are not thinking here about a revaluation reserve of any kind because you haven't actually realised those profits yet. We don't care whether those profits are capital or whether they are revenue. That's irrelevant to us. We're just looking for increased value in the company that justifies the payment of a dividend. Now, for a public company, there's an extra rule. And again, you just need to learn this rule. It says that a public company can only make a distribution if its net assets are not less than the aggregate of its called up share capital and its undistributable reserves. Now, that might sound a little bit like gibberish to you, but what it basically means is if you have a negative revaluation reserve, so you know that there is a loss that's going to hit the company at some point in the future, you have to take that into account. Okay, so it means you're only able to pay a smaller dividend. Now, just while we're looking at distributable reserves, we should look at the opposite side to that, which is undistributable reserves, and there's a list there. Again, I would suggest that you learn this list because it does get tested from time to time. So, share premium account, capital redemption reserve, anything in a revaluation reserved, unrealised profits effectively, and anything that statute or the articles says can't be distributed. Now, the consequences of paying a dividend which isn't paid out of distributable reserves are pretty much on the directors who declared the dividend. So the directors declare the dividend, the shareholders approve it. Therefore, if the directors declare an illegal dividend, it is the directors who are responsible for making good the cost of that dividend to the company. However, if the shareholders knew or should have known that that dividend was an illegal dividend, then the directors can ask the shareholders to reimburse them for the amount of that illegal dividend. There is a defence for the directors, which is that they reasonably relied on properly prepared accounts. So not a back-of-the-envelope job. They actually had some draft accounts drawn up, maybe interim accounts drawn up, and these accounts showed that they were perfectly able to pay a dividend. But for some reason, those accounts turned out to be wrong. Just a point here which might come up, particularly when we look at insolvency. A dividend is only a debt once it's been declared. So even if you are a preference shareholder and you have a right to a cumulative preference dividend, you're not actually entitled to that until it's been declared. Okay? Right, that's the end of the shares section. So I'd like to end it here and then come back and have a look at debentures and charges in the next lecture.